Welcome to This Explainer. Today, we're taking the ACCT428 Master Study Guide and using it to turn you from a mere human calculator into a true financial detective. We're going to completely stop just crunching raw numbers and start unlocking the actual story behind the business.
Okay, let's just get right into it by contrasting two very different approaches. Sweating over a calculator, plugging in formulas, and mixing up ratios, that's the hallmark of weak analysis. That's what amateurs do. A strong analyst totally elevates the game. They don't just hand over a raw number. They explain exactly why those results occurred in the first place, constantly linking the math back to the company's overarching strategy.
Here's our roadmap for today's explainer. We'll hit how to think like an analyst, the 5 financial pillars, the DuPont insight, navigating valuation traps, and finally, real-world application and exams. All right, Section 1, Think Like an Analyst. Setting our core philosophy. Look, the absolute core of what we're doing is captured right here. Financial analysis is about understanding performance, linking numbers to strategy, and explaining why results occur, not just calculating ratios. Honestly, if you just tell me a company's return on equity went up, you haven't told me anything useful yet. But if you tell me it went up due to improved margins and tighter operational efficiency, now you're actually talking like an analyst. Moving on to Section 2, the 5 financial pillars. This is our foundational framework. This right here is the absolute foundation of it all. It's a living, breathing ecosystem. Notice how they feed into each other. Activity is all about efficiency. How well are you using what you've got? That efficiency directly drives your liquidity, meaning your short-term survival and cash flow. Then, solvency steps in for long-haul stability and debt risk. If you can master those 3, you keep the business alive long enough to actually generate profitability, which is where the real value creation happens. And ultimately, that profitability feeds straight into valuation, the market's expectations. It is all totally connected. So, looking at that framework, you might naturally assume hoarding cash is a sign of ultimate strength. Let's pause for a second. Is high liquidity always a good thing? Imagine a company just sitting on a massive, untouched mountain of cash. Well, no, it's actually not always good. That is the classic liquidity trap. A huge pile of cash might simply mean idle resources. Management is basically asleep at the wheel instead of putting that money to work to generate returns. We've also got the activity trap. A lot of people forget that when a company increases its days payable outstanding, meaning they take longer to pay their suppliers, it actually reduces their cash conversion cycle. They hold their cash longer, which is efficient. And the solvency trap. You can't just glance at total debt. Ignoring whether that debt is structured short-term or long-term is a rookie mistake that leads to incredibly weak analysis. Section 3, the DuPont insight. Let's get into profitability analysis. When you're screening a market darling, let's use Tesla as an example, and you see an absolutely massive return on equity, you've got to put on your detective hat. You have to ask, what's actually fueling that ROE? Are they crushing it with incredible core manufacturing operations, or are they just dangerously juicing their numbers with high leverage? Big difference, right? The ultimate solution to that mystery is the DuPont insight. You should always apply this to break ROE down into 3 distinct pieces. Step 1, profit margin. How much of every sales dollar actually hits the bottom line? Step 2, asset turnover. How efficiently are they using their assets to get those sales? And step 3, leverage. How much debt are they pumping in to amplify the returns? By splitting ROE up like this, you expose the real operational truth hiding behind one flashy number. Section 4, navigating valuation traps. Time to talk market expectations. Valuation ratios are honestly an absolute minefield. Take the PE ratio, price to earnings. The classic trap is assuming a high PE is always a good thing. Newsflash, it's not. It could mean the stock is dangerously overvalued. Or look at P/B, price to book. Great for physical assets, but notoriously terrible for tech firms. A tech company's real value is its software and IP, not physical real estate on a balance sheet. And be super careful with price to cash flow, which ignores working capital, or price to sales, which literally tells you absolutely nothing about whether the company actually turns a profit. Furthermore, whatever you do, don't fall into the growth and averaging traps. It is such a common mistake to think growth just magically happens out of nowhere. It doesn't. True growth requires both profitability and reinvestment back into the business. Also, when you look at CAGR, compound annual growth rate, remember what it actually does. It smooths out those wild year-to-year fluctuations to measure average growth over time. The trap? Confusing CAGR with a basic, simple average growth rate. Mathematically, they're totally different beasts. Mix them up, and your entire forecast is toast. Section 5, Real-World Application and Exams. Let's talk execution. In the real world, your workflow is entirely dictated by your tools. If you're digging through annual reports, you're dealing with raw, unfiltered data. It requires slow, manual analysis. But if you have access to a platform like LSG Workspace, you've got processed data at your fingertips for lightning-fast analytics. Knowing exactly where your data originates completely changes how you approach the investigation. As you pull all this data, use a really simple traffic light system to instantly categorize the quality of the financial statements. It's a total lifesaver for guiding your analysis. Green means the metric is fundamentally solid. Yellow is a warning, something's a little off, dig deeper. And red means there is a glaring, immediate risk to the business. And speaking of red flags, you need to pay immediate attention to these three. First, and this is massive, profit not matching cash flow. If a company claims they're wildly profitable on paper, but their bank account is bleeding dry, huge red flag. You also want to instantly flag high leverage, too much debt can sink a ship overnight, and declining margins, which basically screams that the company is losing its pricing power or completely failing to control costs. So, before you turn in that exam or before you hand a real-world report to your boss, run through this final checklist. Did you calculate everything correctly? Did you interpret the results and explain why they happened? Did you link the ratios together using something like DuPont? And did you provide the right context? Make sure you avoid the cardinal sins, ignoring historical trends, mixing up your ratios, and, I really can't stress this enough, ignoring cash flow. As we wrap up this explainer, I'm leaving you with a critical challenge for your very next analysis. When you crack open that next balance sheet or income statement, are you just going to memorize the formulas and act like a human calculator? Or are you finally ready to think like a true financial analyst and explain why? Thanks for hanging out with me on this deep dive, and I'll catch you on the next one.